We've got Harish Krishnan joining in on the show right now to highlight what his market view is right now. Co-CIO and Head Equity at Aditya Birla Sun Life AMC joining in on the show. Harish, hi, morning. Good to have you on the show as always. Harish, what's the sense on the market? And let me pick up first on the small and mid caps. Quite a bit of correction has already played out. At an index level alone, the mid cap index, or rather the small cap index, is already down 15% from its 52-week highs. You think much of the damage is already behind us?
Good morning. So yes, as you rightly pointed out, there's been a small correction in the small cap indices, but to put it in perspective of the bigger picture, right? Even post this correction, we've just come about to levels of where they were in December of 2023. So such has been the extent of the parabolic move that we've seen in these smaller cap and micro cap stocks. That this pullback is welcome. But we still do think that it's going to be a lot more polarized market going ahead. Last year, we did this analysis as of end of calendar year 2023. Close to about 53% of NSE 500 stocks had a 10% alpha against NSE 500. That is one of the highest readings that we have seen on a rolling 12-month basis. So clearly risk has been rewarded significantly over the course of the last 1 year or so. And we do think that it is going to temper down. Pockets of outperformance are going to be a lot more shallower and narrower. And therefore, in this context, while of course the index is corrected, there have been stocks which have corrected even more. There are some pockets of opportunity that do open up, but overall, we do think that large caps still offers a better risk reward compared to going straight on to small caps and micro caps at this point of time.
Harish, this is going to be a very critical next few months as well, right? First, of course, we're coming in the backdrop of the dovish commentary from the Fed stating that irrespective of inflation and their discomfort with the levels that it's still at, they're going to go ahead with those three cuts this year alone. But that said, domestically as well, soon you're going to have earnings, the election dates are already out, and then, of course, later on in the year, you've got US elections as well. Quite a bit of, volatile big events which are lined up ahead. Do you think a more sedate view on the market is what we should look at, and maybe a volatile one as well? And sedate, I only mean in terms of, the average returns.
Yes, that would be our reading as well. We are positive on markets, but I think one shouldn't be expecting big bang fireworks like the way we've seen in the last couple of years or so. I think that came from the context of the fact that earnings almost doubled or more than doubled, over the course of the last 3 years. We do think, generally earnings doubles every 6-7 years for say the market, and we do think that the next doubling will be more in tune with the averages rather than those 3-4 years that we saw in the last 3 years. So that itself should temper down, overall excitement in the market, so to speak. Of course, we are positive on the Indian economy. The fact that we have a counter-cyclical fiscal and monetary policy does mean that whatever growth we are seeing, and we are seeing a very strong growth on the economy side, is coming without any steroids, and therefore the runway for growth and is going to be a lot more longer than a typical cyclical recovery. So therefore we are positive from a longer term construct, but it's going to be a lot more sedate, as you rightly put out, notwithstanding all of the events that you mentioned out. I think just the fact that expectations have possibly run a bit ahead of themselves and therefore need some moderation.
Yeah, as the graph is pretty much indicative, and on the screen itself, we've already seen a 22% return from the start of last year to now. So Harish, what's the ballpark anticipation at an index level alone? Could it be as low as 10 to 12%? And as low, I only use that adjective in comparison to last year's performance, which was a staggering over 22%.
So, we are very poor predictors in the near term, and I think, especially out here, we have a slightly more medium to longer term view. But like I said, I think one has to be going into markets still expecting a lot more somber return outcome. Now, what those numbers will be, it's hard to pencil in, but we do think that earnings, on the broader markets are likely to be in double digits. Especially for the large caps, valuations are not very excessive. We are close to longer term averages, and therefore, there should be a roll forward of that earnings construct, which should give you those, broad numbers that you highlighted. But having said that, these index number prediction is not something that we are very good at, and that's not really our endeavor to focus on what the next 1 year numbers could be.
Harish, morning. Wanted to also understand your outlook on the sector that was the cynosure of all eyes last year, and that was clearly the PSUs. Just wondering what the outlook is. Do you think that the upcoming results is going to be a true test of the performance down the line, and what does the year ahead hold for the space?
So PSUs have clearly, come back into life in the last 2, 3 years, and it has also been led by the greater theme of value doing exceedingly well. So I think it's important to understand, that it's part of a bigger move rather than, just looking at it in isolation. So now. Value in our understanding does exceedingly well when economic activity goes up significantly, and that was the case in the last 3 years, wherein from a complete stop of economic activity during COVID, we've come back very very strongly in terms of the delta in economic activity. So the first derivative of growth has been very very strong, and that impulse typically tends to benefit value a lot more. On top of that, of course, you have the higher interest rates construct in the last year. So both of them have kind of helped the value construct overall. We do think from a style perspective that growth and quality, which have kind of got the rough end of the stick in the last 2, 3 years, will come back into life over the course of the next, 18, 24 months. So in that context, we are far more sanguine about the growth oriented sectors and the quality oriented sectors. Now, of course, there is always going to be an intersection of some of the PSUs within that pack. There are a lot of PSUs which are in that intersection of good growth, especially the larger public sector banks. Certain niches, for example, logistics could be another area where there are certain public sector enterprises which can see a very strong growth, especially as the dedicated freight corridor comes into operation. So there are pockets out there, but we do think that that big move that we saw was more a culmination of the value trade, and we think that over the course of the next 18, 24 months, we would get back into the more sedate growth and quality at a reasonable price kind of a style. And therefore we are now very selective in terms of our PSU view, in terms of the kind of returns that they can come through. Even as we are positive on them, I think returns are going to be a lot more sedate compared to what they've seen in the last 3 years.
Right, Harish. Surely, you are selective on PSUs, but any specific pocket? You said there are some pockets. So, which specific pocket in PSUs would you look at? Would it be the PSU bank side, the defense side? What is it that one should look at in the PSU basket then?
So on the bank side, I think on the larger banks, we are a lot more positive on. There really is something, over there. Clearly, there has been a reasonable improvement in the franchise value in our assessment, especially on the larger side. On the defense side, we are a lot more sanguine, primarily because while there is a near-term excitement of greater spend on defense, you also have greater focus in terms of the export opportunities that come from defense. I think the valuations have gone significantly ahead of expectations. So just as a point, today the defense index, which is the NSE Defense Index, has a price to book close to about 10 times, which is higher than that of the NSE Consumption Index. Now, these are very, very rarefied price to book valuation entry multiples. So therefore, we do think a meaningful cool off in terms of sectors like defense, even in certain pockets like railways, where we think that there's been an extended kind of a run. Of course, there's a lot positive going on. Sentiment continues to remain, very exuberant, and activity is also, quite good. But it's just that, these pockets have got significantly pulled forward. And therefore, we do expect other pockets within the PSU, to do well, be that of banking, be that of, certain logistic companies, some gas companies. Those are the areas that we are far more positive on.
Sure. So, Harish, while at an index level, it all may look hunky-dory in the year gone by, and some of the pockets as well have shown very bright, the fact of the matter is that it's not been an across-the-board participation. Out of those underperforming sectors, which have not really seen or rather participated in this exuberant bull market that we've had in the last year, year and a half, are there any dark horses that you think are worth betting on now?
Right. So we think there are four potential dark horse candidates from a sectoral point of view, from the medium-term point of view. First is pharmaceutical. This is a space, over a 5-year horizon hasn't really participated and kept in pace with the overall markets. There has been a reasonable amount of deleveraging that has happened. A lot of big capital allocation which went to US specifically is now getting corrected. And there are API prices which have kind of cooled off. So while pharma is a very heterogeneous and bottom-up sector, we think that would be an area to look out for. Second could be metals. This is a space which is very dependent on China. Today, of course, we've got a lot of negative print on China, but we do think that, when pushed to a wall, the government will come out. While we're not expecting big bang spend on, fixed asset creation, we do think that there is going to be some kind of, a softer push towards broader infra build out. And that is another area where we think that, which hasn't really participated, and that would be an interesting opportunity. The third area is that of consumer durables. Consumer durables, have been on an underperforming streak from 2018, 2019. This was a time frame when, post demonetization, there was a significant uptake, and there was a lot of current account deficit from trading from China, and therefore there was a significant need to invest in capacities. So balance sheets of most companies have doubled and tripled during these 5-6 years. Demand hasn't kept pace, and competition has meant that overall gross margins have come down, as well as many of them are loss making. To our mind, this becomes a very interesting point, because we think that the real estate cycle started in 2020-21, and the keys are likely to be handed over in 24-25. And therefore, we do think that there is a potential for demand to come back, as well as supply sanity to prevail, which therefore puts us in a very interesting point as far as consumer durables is concerned. And the fourth pack is a very small sector, that of media. This has been a pack which, over 10 years, the NSE media hasn't really delivered. We are seeing signs of consolidation within this industry. They are becoming more and more into the top 2, top 3 kind of networks. We do think that, there will be a focus on cash flows and higher profitability over a period of time, and this is therefore another interesting sector to have as a dark horse kind of a thing to evaluate, and therefore to size up as these sectors start getting back into momentum.
Right. Harish, there are certain pockets which have already done well. Real estate, we know that has started seeing an up move, and that trajectory is going to continue for a while. Anything other than that, you expect, despite the outperformance, that we could see an up move continue in these sectors? And what's your thought on something like power as well?
So yes, we are positive on the investment cycle. I think that has moved quite meaningfully. If the last decade was that of consumption, we think that this decade, or at least the first half of this decade, is going to be more of investment. And therefore, sectors like, say, capital goods and engineering, realty, as you mentioned out, even sectors like auto and auto ancillaries have, we do think that, they've performed, but there still can be room for further performance. Cement is another sector where we think that, from a medium-term construct, there is a consolidation wave happening. Energy prices are beginning to stabilize, and therefore that is another area that we think, can continue to work through. The last is, of course, IT services. This has been a market performer in the last 12 odd months or so. But from a pre-COVID to a post-COVID, we do think that IT services have moved meaningfully, and we think that that trend can sustain, even as there is a near-term worry of a softening in the advanced economies. We do think that IT services can see a meaningful upshift over the medium term. So these are the five odd sectors that we continue to have a reasonable positive view. With respect to the power sector, I guess we are selective out there. There are pockets on the thermal side, clearly, given the peak power demand that we have, that we are evaluating and we have a positive view on. There's also again plays on the capital goods side and the engineering side, which are more derivative plays of the power capex that can come through. So that's the other area of opportunity that we are positive on. So these are the 5-6 sectors that have done well, which we think can continue to potentially do well, and we have an overweight stance on.
Okay, thank you so much, Harish, for joining in with us this morning on ET Now, giving us your thoughts on all the different sectors that one should look at as well as on the market.